Now, when we look at gold to silver ratio, I get asked this question all the time. What should I buy? Should I buy gold? Should I buy silver? Should I buy a bit of both? And honestly, the real answer is there's no one answer. It depends on each person. But the main tool that we look at, if capital appreciation is your number one goal here, right? If you're just looking to make money, it's the gold to silver ratio. It's a really easy thing to calculate. All you have to do is take the price of gold and divide it by the price of silver. Okay. What you're going to see on this chart and tracking this since 1915, the average has been 53 to 1 over 110 years. Now, the other thing is the average, which you'll see in the 19th century, or I beg your pardon, the 20th century, was 40 to 1. So we're seeing this extending as we move in. But people often ask, how the banks get their projections for silver or gold. Is gold the one to buy? Is silver the one to buy? If we look at the average ratio of 53 to 1, right? And we just take the price of gold today at $4,100 and we divide that by 53. That would give us $77.36 silver. Okay. Currently, the silver market's at 52, right? The ratio is wider than 80 to 1. So what that tells us is silver is incredibly undervalued when compared to gold. And in fact, what we know is anytime the ratio is wider than 80 to 1, silver makes 4.5% for every 1% that gold makes. So if capital appreciation is your number one priority, silver is the buy over gold. If you're looking for steady Eddie, you want to meet inflation and you don't necessarily care about getting the biggest returns, because we have clients at that phase of their life, right? They just want something stable. Gold is the right move. But the gold to silver ratio is the number one indicator you can use to determine that. Now, lastly, this is a risk reward chart from CPM Group. It's from the same 50 plus year study that we saw 2 slides ago. And what you'll notice with this is showing the risk versus return percentage. And the risk that's calculated here is not per se risk that you face in holding that amount of precious metals. It's risk that you're losing out on potentially higher yielding returns in a shorter period of time in the stock market and what would be defined as a riskier play. What you'll notice is the average return over 50 years of investors went up as they added more gold into their portfolio and invested less in S&P and T-bills. So investors that hold 70% of their portfolio in gold on average had over 9% returns a year over 50 years. Over the same time frame, if you had all your money in the S&P, your average return would have been somewhere near 7.1% a year. And this is a major difference, 2%, when you figure compounding interest over a 50-year period. But the reason you'll notice they're recommending 25 to 30% is you'll see in the sweet spot, your risk doesn't change much between 25 to 30% of missing out on bigger returns. At the same token, your return is still above what it would be if you put your money in the S&P.